I'm joined today by Will Thomson, founder and managing partner of Massif Capital here in Charlotte, North Carolina. Thanks for being with us here today, Will.
Thrilled to be here.
Yeah, so happy you're sitting down with the MOI Global Community. Before we get going, I should note that John, chairman of MOI, does have a stake in Massif Capital, just for disclosure. So with that out of the way, what I want to talk about, I want to touch on a couple themes today. One being sort of the structure, administration of your fund, how you run it, how you built it. And then I want to get sort of to your strategy and your focus on real assets. But before we do those two things, why don't we start with just a little bit of background, sort of how you got here, what is Massif Capital, and why you chose to do this for your career.
I guess it's a winding path to get here. So Massif Capital, we're actually 10 years old this year, I think in October or something. So we've been around a little while. Before that, I had worked in finance and had worked for the government, the U.S. government, the DoD for a little bit, had been in healthcare investment banking, a little bit of private equity, and insurance with Lloyd's of London, writing political and credit risk insurance. So diversity of things. The last job before Massif was the insurance job. And what was interesting about that was we were writing policies for oil companies, mining firms, renewable energy developers who were building assets, refineries, all kinds of different assets, building things in foreign countries and looking for business interruption insurance, or they were, Glencore was a big client of mine, and they would buy copper from someone and they want to insure the delivery of the copper. So there was all these sort of interesting little business operation risks that these companies had. And we ran a very clean book, and I loved sort of focusing on those businesses and focusing on those companies. But with insurance, you only make money if nothing goes wrong, and when nothing goes wrong, you only make a little bit of money. And with political risk and credit risk insurance, you could write policies all year long, and if just one policy goes wrong, the sort of the asymmetry in the value of the policy versus the payment is just going to wipe you out for the year. And so we ran a very clean book, and so I wanted to benefit a little bit in the upside from the ability to run that clean a book. And so the options were pretty limited. No one in New York was investing in mining firms. They weren't investing in some investment in industrials, but not a lot of investment in energy. And so my options were sort of to start my own business or sort of find a job at another fund, maybe doing something tangential. And so I just decided to go off on my own and hung up a shingle. And I think for the first year, it was just me. The second year, it was just me. Third year, I had a partner who joined. That partner stuck with me until beginning of last year, actually. And then he took a job running business development for a EV charging company that was a publicly traded company called EVgo. And so now it's back to just me, and we're in the process of hiring. So,
can you walk us through the structure of your fund, the legal structure, sort of how you determined that?
Yeah. So initially, so the costs of starting a fund are pretty significant. They don't have to be, hundreds of thousands of dollars. You can do it much cheaper than that. But it's certainly not cheap, especially lawyers, accountants, etc. So initially, we started off running separately managed accounts through Interactive Brokers. And I would encourage sort of anyone who's thinking about, say, starting a fund or sort of heading down this path of managing money, that is a zero cost, basically, way, we're talking a couple $1,000s, right? A zero cost way of getting started. We managed separately managed accounts from 2016 until 2020. And then we got a seed from a family office to start the fund. Now the fund is a domestic limited partnership. and we also have an offshore entity in the British Virgin Islands. And from a structuring standpoint, there are sort of two different ways of doing it. You can have what's called a master feeder structure, which is to say the primary fund is offshore, and you get different funds feeding into that offshore entity. Or you can do what we've done, which is we have a domestic U.S. fund, and the offshore entity feeds into that, what they call a mini master fund structure.
Any advantages for one or the other, depending on the situation, or how do you dissect that?
Yeah, so we chose this mini master structure more from for cost reasons than for actual for any other reason. From an investing standpoint, there are more benefits to the master feeder structure, with the offshore entity being the primary fund that is doing the actual investing. And that has to do with, both U.S. regulations, but also the regulations of sort of, numerous other countries. So, for example, while we are primarily, 95% of our assets, if you will, are in equities, we do use options for hedging and options for trading and things like that. So we use options. U.S. domestic fund cannot buy, say, options in Europe. If you want to buy options on a European exchange, you need an offshore entity to be doing the buying. So there are more, you can expand the universe of assets and securities you can invest in if you have a master feeder structure, as opposed to what we're doing. But we had just stood up the fund when we launched the offshore entity, and so we had just gone through the process of paying the lawyers and the accountants, et cetera, to build the offshore, or to build the domestic entity, to do the paperwork, et cetera. And I just wasn't really willing to spend the money to sort of scrap all of it 12 months in and rebuild it offshore. And it's especially given, so we've done a couple of things that the accountants and lawyers disapprove of. And mostly it's associated with costs. And I think it's worth noting, just because we chose to eat the cost of starting the fund. Okay, most hedge funds charge the cost, the legal work, et cetera, back to the fund. And so your clients, if you will, your investment partners, end up paying for it. And look, they spread it out over the course of 5 years. It's standard operating procedure within the hedge fund industry to charge back a lot of those costs. It felt like going into a Starbucks and Starbucks saying, we're going to charge you extra for the building. It seemed, I don't know, it didn't seem appropriate to charge the customers, if you will, for the cost of starting the business.
So was that a decision you guys made yourselves at sort of the consultants or the third parties, they did not expect you to do this?
No, they were like, that's not really what happens. And I was like, well, the other way around doesn't really seem terribly fair.
Do you have any advice or sort of, in your experience of selecting those third parties in the early going? I'm assuming there's consultants that are abreast of all this. Anything from your experience that people should think about or know that would help them?
Selecting your service providers. So for a fund like mine, okay, we've got accountant, lawyer, administrator, prime broker, regulatory consultant, offshore lawyer, offshore regulatory consultant / operations assistant, and then middle and back office service provider. So I don't know what, I assume I counted correctly here. Something like 7 or 8. We have a regulatory consultant. So 7 or 8 service providers. What I would say is that you really just want to get along with them. It seems to me that a lot of them do a very good job, and especially if you are. So we selected everyone, there's sort of like a top tier, let's say, for accountants. Let's say it's Ernst & Young, it's KPG, a couple of those guys, whatever, Price Waterhouse Coopers. We selected from the second tier. And to be perfectly frank, if you're in the first or second tier, the work is going to be good. And so my approach was, who do I actually want to work with? Who do I think if I call them up, they're going to say, okay, we can work on this. We can't do it today, but we're going to get to this quickly. And, that's sort of what was important to me, someone I could work with. And I think, sitting down, going to their offices, stuff like that, that's important to get to know these people, because they admittedly are not direct hires, but they take the place of direct hires. And so you want to get along with them, you want to work with them. I talk with the accountants. I mean, right now I'm talking with, because we're in the middle of tax and audit season, so I'm talking with the accountants and the middle and back office service providers every day. And so if you don't get along with them, makes it hard.
Have you thought about at some point sort of growing internally, or do you feel like that's a good setup for a pretty long runway?
I think it's a really good setup for a really long runway. I think outsourcing, so at one point, maybe 10 years ago when I first started, talking with people about sort of the path to take, I'm not sure outsourcing to the degree we have was as widely accepted as it's become. But now nobody blinks an eye. And so I think until you can well afford to hire internally, and it's not it doesn't cause you to even think twice, the outsourcing works. And there are probably things we'll just never bother bringing internal.
Can you walk us through your fee structure?
Mm-hmm. So we have 3 share classes. We have, and keep in mind, our thought process when it comes to fees is I am always looking to trade fees for lockup. So I am always willing to give more and more discounts, if you will, on especially the management fee, but management or performance, if someone is willing to lock up the cash longer and longer. And so that's sort of how our fee structure works. So if you lock up your cash with us for 1 year, you get charged a 1.5% management fee and a 17% performance fee with a high watermark and a hurdle rate. The high watermark and the hurdle rate, you don't pay performance until after we cross the hurdle rate, and the high watermark is basically set up such that you never pay for the same performance twice. The second share class is a 3-year lockup, and you get 1.25% management fee and 17% performance. And then the third share class is a 5-year lockup, and you get a 1.25% management fee with a 15% performance over an 8% hurdle. So I think it's pretty, with both the high watermark and the hurdle rate, the interests are aligned really well between the sort of investor, the limited partner, and myself and the fund. And then obviously with us, we try to push everyone into those longer share classes, and we'll sort of give more discounts depending on what how much you're willing to lock it up for.
So how did you go about determining like that hurdle rate, how to implement the high water mark, and then thinking about providing liquidity? It sounds like you have chosen that trade-off on the fees versus lockup. I'm hearing you, but what are the key elements that you think about in terms of providing customer service and a quality product to your client versus your benchmark, or et cetera, and really trying to dial in where those things are?
I can't claim that there was anything terribly sophisticated going on. I mean, look, obviously we we'd all love to go back to the day where it was 2 and 20, and that's what it was, and everyone took it. But that's not where we are. And as a fund that is not only investing in niche assets, which makes it a little harder to find LPs, but a fund that is still small in the grand scheme of things. I felt that charging a reasonable but not aggressive rate relative to the industry overall was sort of the way to go. And at the time we set that rate structure, I think the average management fee was closer to 1.7. And so we just lopped a little off. I think now that average management fee is probably something similar, somewhere between our high at 1.5 and 1.7 where it was when we set it. It's a sufficient amount that we always just looked at, or at least I always just looked at different amounts of AUM and how much of the expense structure it would cover versus how much runway I had, as we were building to profitability and stuff like that. And so we always just tried to make it break even at 25 million, which was sort of like 10 to 15 million less than all the consultants or all the people I spoke with said would be possible. It does turn out to be possible. So I think a lot of people will tell you need to have 60 million under management in order to break even and things like that. Those are numbers I hear tossed around a lot. If you're willing to sort of look around a little bit more and be a little bit more creative about where you're spending your money, there's no reason why you can't get to break even in profitability far quicker than a lot of funds that fail because they never do.
What is your benchmark, and how'd you go about determining that, and how'd you think about reporting, as it relates to that? Yeah. Reporting performance and fees.
So we have a couple of benchmarks. So we invest in what we call the liquid real asset universe. Okay, it's primarily energy firms of all kinds: oil, natural gas, renewables, utilities, etc. Materials companies, chemicals, mining, construction material, etc., agriculture, and then industrials. And so that combination doesn't lend itself well to any particular index or benchmark. There is an S&P Real Assets Total Return Equity Index that looks at, again, the companies involved in real assets. But interestingly enough, the real estate segment, which we do not invest in and don't know anything about, overwhelms that index quite a bit. And so while we do, say, have the S&P Total Return, Real Assets Total Return Index on our tear sheet, and we do report its performance because it's something easy for our investors to look up. I actually think because we've clearly defined what we invest in, and that's everything over 200 million in market cap within a certain number of countries that we can trade in via our prime broker, because we have that really defined universe in very specific industries, I actually think benchmarking against the universe makes the most sense. And so we have created a custom index which we benchmark against. And so the question basically becomes, are you picking the best stocks from all the stocks that you can pick from? And I think that's far more informative, frankly, than a lot of other indices. It does have the drawback that some of our clients can't look it up and they have to come back to us to get the results. But it's much more telling of whether we are picking stocks well or not.
How dynamic is that universe? Does it change a lot? Just in terms of composition?
Yeah, in terms of composition, we rerun it, if you will, once a year and sort of rebalance the index, which is market cap weighted, although we also have an equal weight one just to compare to. Doesn't change that much, and it's mostly, it's mostly foreign firms is where the change is coming in, especially in emerging markets, and it tends to be on the lower end of the market cap scale, right? So you've got companies on the edge of that $200 million mark that are coming in and out. But in the grand scheme of things, the composition doesn't change too much, and where it does, the impact is pretty limited.
So do you have thoughts on whether you should, or whether one should report sort of gross or net of fees, and then do you sort of report an alpha versus that universe?
Yeah, so we only report net of fees. I mean, if someone wanted our gross of fees number, I'm happy to give it to them, but I don't, you can't get it, right? You could only get the net of fees number, so that's what we sell. I can't imagine that there are many people who do report the gross, or that there are people that pay all that much attention to it, but I don't know. I guess with multi-strat firms, it's probably helpful because they have straight flow through of all costs, to the client, so it's a little easier perhaps to see what you're paying. But we produce we report the net. We do report alpha versus the universe, and we report alpha versus the Russell 2000, just because we have a tendency to be more small and mid cap in our sort of investment style. So yeah.
What kind of technologies do you think are critical to your process? I'm curious if you've incorporated AI or if there are others that.
Boy, has it changed over the last year. So when I first started, I used nothing except Microsoft Office and Excel, and I sat and I used a printer a lot. That's always one thing that I've always been quite sort of liberal with. Is just if I want to print something to read it, I'm going to print it to read it. So you definitely need a printer. But over time, that has evolved as the firm has evolved, and so now we have Bloomberg. We have something called Macrobond. We use a piece of software called Alpha Theory, and we use a lot of AI, and we do a pretty significant amount of AI integration into our note-taking, and especially a lot of AI in terms of creating. So we use a program called Obsidian to take our notes. And Obsidian is nice because you can build plugins for it. And to be perfectly frank, I don't even build the plugins anymore. I just have ChatGPT write the plugin. But you can build plugins that allow you to do things like download all the podcasts that you listen to, transcribe them all, drop them into the folder within Obsidian, and then create links to all the other notes that they're relevant to. So I listen to a podcast called the Global Lithium Podcast. And so every time a Global Lithium podcast comes out, it just gets pulled, downloaded to the folder, transcribed, and then any company that gets mentioned, it's a link to the company page within Obsidian. Any discussion of a country gets linked to the country's page. And so you create this very dense sort of network of information, and it's sort of an automated Wikipedia that is relevant to the work we do. So we use a lot of AI for that type of thing.
That's very interesting. So do you think if someone starting out, maybe one of the best things they could do is just learn to utilize AI in general?
Oh yeah. And the other place I find it just tremendously useful is, we've got data and information overload at this point. I mean, every day I get, I don't know, I think I get 50 emails from Bloomberg relevant to certain, I've made selections of different newsletters or whatnot to listen to or to read. And so I get 50 emails from Bloomberg every day. I get a bunch of emails from different sort of geopolitical think tanks or stuff like that because we're operating internationally every day. Then we get company information. Sorting through what to read, what not to read is itself time consuming. But with AI, you can sort of, those 50 emails I get from Bloomberg, for example, I don't read them anymore. What happens is they get pulled in, and I get, at the end of the day, I get basically a 1-paragraph summary of each one. And, the summary is decent, and it allows me to figure out what I actually need to read. And then you've got tremendous value in the ability to, say, take all those PDFs that you get. And we all have one of those folders where we're like, I'm going to download that PDF. I'll get to it. I'll read it. I'm going to dump it in this folder. We all have one of those folders. I don't have one of those folders anymore because the PDF gets pulled in. It gets summarized. I get the summary at the end of the day. And I say, probably don't need to read that. Or, okay, I'll read that, in which case I pull it out and read it right then and there. Most, 50, 60-page PDFs that we get are probably not worth reading. The summary is sufficient to get the idea, and then it lets you figure out what you really need to read.
Do you feel like you've gotten real leverage there in your research process and your results?
I do. I find myself, I feel like I'm better informed about what's going on in, especially with individual companies. It's quite interesting. My ability to keep track of what all the different businesses that maybe are on watch lists are doing is much higher. Because again, it all gets pulled in, and I just get these summaries, and so. Whereas I used to, perhaps have a watch list, and let's say it was oil and natural gas companies in the United States, and maybe there were 20 or 10 or 20 that I was following. I wouldn't necessarily know on any given day, what they were all doing. But now I get these nice short little summaries of what's happened, and it increases awareness quite dramatically. And I do think it increases your ability to figure out what you need to read to find some signal. And it makes you focus on asking good questions. Because that's the only job all of a sudden. The only job is I need to ask this machine good questions such that it extracts useful information. And there's no end to the value of figuring out how to ask better questions.
So it's beyond just, sort of raising your awareness and focusing your attention. You can use that technology to then, go forward in your research and, ask it questions as you're sort of building out, underwriting those assets.
Yeah, it's a research partner. Yeah. We use Perplexity, and we use it via an API into Obsidian. But I sit there and ask it questions about my notes or what's in that Obsidian database basically all day long. It'll become a reasonable expense, if you will, over time. All those data, all that data, asking it to, compute all these things. I probably use the electricity of like a small state or something.
Okay, great. So shifting gears a little bit, can you tell us a little bit about the Real Asset Handbook and sort of what you're publishing there? And then more broadly, I'm just curious if you have thoughts on the importance of having something to publish like that if you're in this industry.
So the Real Asset Handbook, so we've been publishing our research for, the entire time we've been in business. At this point, we've built up a subscriber base, if you will, for our research of about 20,000 people. So there are a lot of readers. And this year we've decided to sort of monetize it and put some of it behind a paywall. And so that's the Real Asset, that's what we're calling the Real Asset Handbook. And basically that's, we have historically published some sort of report every 2 weeks. And so that's what that is. And they bounce around. A couple weeks ago, we published a report on geopolitics. On Tuesday of next week, we're publishing a report on a trio of companies that manufacture the equipment to produce what's called ultra pure water, which is what they use in semiconductor manufacturing. And then we're going to do a primer on the silicon carbide industry. So, things bounce around, and then we produce company reports. This industry, the only thing you have to sell is yourself and your results and your thinking. And the only way to communicate your thinking is either through the results or through research and results. Obviously, results are within your control to a degree, but any given moment, they absolutely are not within your control. So I think having both the research and the results obviously is critical. And in terms of getting to know who you are, getting to know your investment process, getting to know how you think about things, the research is sort of essential for potential investors and for existing investors who you obviously want to keep. So I think it's a business that lends itself well to publishing because everything we do ends up in notes, in words, etc., somewhere. And so all you need to do is collect it all and sort of put it together in a presentable format. And your day-to-day becomes an additional piece of marketing material, if you will.
But does it feel like that is also a piece of your marketing strategy, or is it just sort of incidental?
I think it's the critical sort of component of your marketing strategy. I don't know what else again, you have a choice. You can market your results, which, sort of everyone has to do. But if that's all you're going to market, then they better be frickin' good. There better not be down years because you can't sell a down year, right? So I think the research is critical. And in this day and age with the platforms that are available, whether that be Substack or we use something called Beehive, which basically looks just like Substack, there's all kinds of ways to not only get your message out, but amplify your message and, in time, as we're going to do, actually monetize it in addition to it serving as marketing. And so it becomes useful in all kinds of ways. And I think one of the challenges, especially with a startup, and we're 10 years in, but I still think of ourselves as a startup, is, every day you're trying to sort of fight to get better at your job, but you're also trying to extend the runway of the firm another day, another week, another month. That additional revenue stream, that additional sort of connection with people helps to grow that runway.
So any sort of tips, recommendations, best practices from your experience in optimizing all that and getting the best out of it, getting the most out of it?
Everybody writes a little differently. So it's sort of like I had a conversation with Chris Bloomstrand, who you know, and who MOI community knows quite well, at some point, and there were a couple of us, I think it was at a recent Lattice Works in New York, about his process for writing his letter, right? And he writes this big letter every year. It would not have worked for me. Like, that process works for him. But boy, would it would I would get nothing written if I used his process. So I think writing is quite person specific. But I think the most important thing is just getting started, right? You got to sit down and you just got to do it. And if you don't have a lot of practice and experience, so I was a philosophy major, so all I did was write throughout college. My roommate was an engineer. I don't think he wrote a sentence all of college. It could be harder, but writing is a critical skill that we all have to learn.
Do you have any other strategic partnerships or alliances in sort of like fund or wealth managers, institutional investors, fintech firms, et cetera, that sort of help funnel capital in or push that marketing message out?
So we have a relationship with a multi-strat who buys our portfolio sort of outright and deploys it as they see fit. They invest in every idea, but how they size the positions and things like that is up to them. So that is an interesting avenue that sort of came about 2 years ago, I think, or 3 years ago. And I think I'm hopeful, actually, that perhaps that grows. Because, look, we talk about, maybe it never grows Citadel and Millennium, right? Maybe they never engage in that type of action. But if you think about all the different ways that you could assemble portfolios, the multi-strat sort of approach and just sort of paying a fee to people like me, smaller funds, in exchange for the portfolio and give me a little bit of performance is a pretty cost-effective way to sort of build a multi-strat. And so that relationship has been great for us. I think it's been good for them because we've generated good alpha for them. And I'd love to see more of it. I'd be happy running an entire portfolio, if you will, that had very little capital that I deployed myself, but which a bunch of different people paid me a fee to utilize in that particular way. Then we also, as I mentioned before, we have a relationship with a fintech here in Charlotte called Alpha Theory. And I think it's a great little piece of software. It sort of forces you as a portfolio manager to be very disciplined about your valuation. It's got a sort of an interface that you go in and it says, we want scenarios and we want probabilities on those scenarios. And then we will produce a probability weighted value once you give us those scenarios. And you can do that in Excel really easily, don't get me wrong. But it's just a nice interface that forces you to do it. And then there are some bells and whistles, that let you have some notes and things like that in the right places at the right times. I think that piece of software is tremendously valuable. And then one of the nice things it does is we're always worried about and always thinking about position sizing, right? So there are some things in investing which seem, in some regards, sort of like extremely well-trodden territory that is, I wouldn't necessarily say easy to execute, but easy to understand conceptually. One of them is, say, valuing a business, right? Like we all conceptually understand it. Whether we execute it well or not, whole other story. But position sizing is not something that has been written about broadly. It's not something that has been written about particularly well where it has been written about, and is quite challenging. Alpha theory helps in that regard because it says, well, what would the ideal position for you be? What would the return be? How big would it be, et cetera, if it was perfect, right? And so then it takes that perfect, that position. In our case, it's a position that I'm willing to allocate as much as 10% on day one to an investment, but it needs to hit these various sort of marks. And I need to be able to get a minimum of a 14% annualized return from it, and various different things like that. And it takes what you've put in as the scenarios and the valuation and different other variables, and it scales it sort of linearly against what perfect is. And so it gives you an idea in a very systematic fashion of what, given your idea of perfect, how far off this idea is from perfect, and thus how big you should size it within your portfolio. So I think that's been a fruitful relationship and an instructive, it's a useful and instructive piece of software.
Would you argue that perhaps that's one of the last places to really find edge is in position sizing and how long you hold on and all that?
No. Maybe if you are in consumer goods or you are in healthcare or something like that, where it's very crowded, maybe that is the last place there's edge. But for liquid real assets, with a few exceptions, right? Like I add no value and can add no value to, say, someone evaluating ExxonMobil, right? Like it's got 50 analysts covering it, and, something like that. But generally speaking, mining firms or energy firms internationally, or sort of quirky industrial businesses, like, for instance, as I mentioned, sort of these companies that manufacture the equipment for ultra pure water, which is basically used by the pharmaceutical industry and the semiconductor industry. I still think there's a lot of edge to be had in just doing the basic research to understand what the businesses do. Very technical businesses that require a bunch of operational expertise, I still think there's a tremendous edge to be had in doing the research. That being said, I do think position sizing and how long you hold it and things like that, those absolutely are places where there's edge.
Can we go back to the multi-strat thing just for a second? I'm curious if you could talk a little bit about how that came about and sort of what advice you might have to someone that's interested in drumming up that type of business.
Yeah, if you've got advice, come give me a call. They found me. So the marketing, the research is how they found me. So, once again, going back to that, write frequently, put your ideas out there. But I have not found other multi-strats who are pursuing that particular approach. Obviously, the multi-strats love to give money to teams that spin out from inside the multi-strat themselves. So I haven't found any others that are doing this, but I think the advice is you put your ideas out there, and something good will happen eventually. It's just a question of whether you can survive to eventually.
Do you think there's anything unique about the real asset space that sort of informs or supports any of this that we've talked about, your structure, your marketing?
I think from a marketing perspective, it's we cover a good group of companies and industries to be publishing stuff that others aren't. And, that does attract readership. So, especially say the mining stuff, I can think of like 3 or 4 mining focused hedge funds globally. There's not a lot of people who do or know anything, know much of anything about mining. And so, that focus helps us write interesting and unique things, which in turn helps us attract attention from people. But that would be sort of the only sort of insight I would have in that regard.
What, in your mind, are the key differences between underwriting a real asset, a real asset compared to a traditional financial asset or other type of business?
For better or worse, there is a timing component to real assets that is a little more important. But just to be clear, that timing component, I'm not talking about, say, commodity cycles and timing commodity cycles. I'm talking about the fact that if you, there are sort of two categories of businesses within real assets. There's businesses that are projects, and then there are a few businesses that are going concerns, but mostly that's in the industrial segment, right? And so evaluating the industrial companies, no different than evaluating sort of any other business, if you will, from a value investor perspective. But those project businesses have a fixed life, and they have a very technical peak valuation point before they start to, the value starts to erode because the asset that is being monetized starts to erode. And so you have to be careful around that sort of timeline because you can't hold a mining firm until the mine is kaput because there's nothing of value there at the end. So you just have to be thoughtful about that timing component of when you're getting in relative to the life cycle of the business and relative to what management says their intentions are. Some management teams have the intention of trying to build another mine. I wouldn't really want to be in that company probably if it was sequenced in that way. But a lot of management teams, they want to build and operate the one mine, and after that, they'll close the business down and go off and do something else. So you just have to be careful with that timing component.
So let's dive into that a little bit. I mean, I know you've talked a lot about capital allocation and returning capital being paramount in this industry. How do you think about that in terms of just generically grading a management team or comparing assets?
Well, the capital return component in real assets ends up being a function, or the demands that I put on the management team in my evaluation ends up being a function very much of their strategy. So take a company like Equinox, which is a gold miner that we've been invested in quite painfully at times for, I don't know, I guess we first invested in it in 2018. It's gone up, it's gone down, it's gone up, it's gone down. But they set out on day one and they were like, we would like to be a 1 million ounce producer. Okay, so they want to produce 1 million ounces of gold a year. Just to sort of contextualize that, the world's largest producers like Newmont and Barrick, they produce 4 million to 6 million ounces a year. Okay, so 1 million ounces a year makes you, sort of a big boy, a very large producer. That's their goal. They've said that from the beginning. I had no expectation that they would return capital at any point along that path. That capital was all going to be reinvested in trying to acquire new assets, build new mines, et cetera, and become a 1 million ounce producer. On the other hand, we're invested in a company called Alphamin, which is a tin miner in the Democratic Republic of Congo. They have some extension opportunities, but other than that, this company has no intention of doing anything. They're going to mine the tin at that site. They're not going off looking for other tin mines globally. They are just operating that one mine. Now, it's a huge mine. It's got the world's highest tin grade, and they produce, at this point, it's probably pretty close to 10% of the world's tin. But if that's all they want to do, they have got to return capital. And interestingly enough, at this point, because of some political issues in the DRC, I mean, the yield on that, the dividend yield is like 14%. That's a little, that's where I would like to buy in, and I'd like a little capital appreciation and bring that dividend yield down a little bit. That's the type of thing that a real asset business that's running a project should be looking to accomplish. They should be looking to try and return, pretty close to double digits to you via dividend, in my opinion.
How do you tease that out of your research to get confident with management strategy and intentions?
I'm a big believer in talking with management quite a bit, and especially when it comes to mining firms, going out and visiting the assets. Going out and visiting management, I think it can be controversial. I know some people don't like to do it. But I got to look the person in the eye and sort of shake their hand. And, admittedly, look, sometimes we don't do that. We invested in Barrick Gold at one point. I didn't visit any of Barrick Gold's gold mines, and I wasn't going to be able to schedule an appointment with the CEO. But, if you just want to run one mine in the Democratic Republic of Congo, I want to talk with you every quarter probably. And I do. And look, that cuts both ways. You develop a little bit of a friendship, and, you've got to be careful about making sure that you're still evaluating the management team, clearly without sort of rose-colored tinted glasses, if you will. And I think you just need to be constantly reminded of that. and Equinox is a perfect example. Like, I have had moments where I'm like, do I know this management team too well? Have I spent too much time with them at different mine sites? Am I no longer sort of seeing this clearly? Am I now? One of the questions I'm always asking myself is, as an entrepreneur, I have to wake up every morning cognizant of the fact that my business could fail, but sort of naive enough to say, well, that's impossible, I won't fail, and sort of keep going day after day after day. Sometimes I find when you get too close to management, if you ask yourself the question, have I entered sort of the entrepreneurial mindset that their management team must be in, but I am not in? That helps me clarify that sort of situation, if that makes any sense.
Yeah. Makes sense. It's not an enviable task.
What is it?
But trying to get confidence in someone else's strategy or
And again, it's a question of whether you have sort of become naive about the potential challenges of them accomplishing their goal. Because I think, again, I have always, every day, I have to be naive about the potential of accomplishing the goal of continuing to build massive capital. Otherwise, I just wouldn't get up in the morning and, if you knew how hard it was to start a business, you'd never start one. It's that sort of situation. And so you have to ask that question about your perception of management.
So with your years of experience in the real asset space, are there any sort of common misconceptions about real assets that you've came across and things you would rectify if you could?
Yeah, I mean, there's a few of them. I think a couple of the big ones. So none of the businesses are simple and straightforward. They're all quite technically complicated. And they're all businesses that have tremendous operational leverage. And so understanding that technicality becomes pretty important. I would also say that I think that this commentary applies across the board to all commodity producers, but I've only tested it, if you will, and confirmed it in regards to mining, but I believe it does hold based on what I've seen. About 50% of equity returns for anyone in the energy space or the mining space or, say, bulk chemicals and things like that, about 50% can sort of very directly be tied to whatever it is they're selling and whether it's going up or down. The other 50% tends to be associated with something else. Sometimes it's something the company's doing, sometimes it's not. But more importantly, perhaps, those two things almost never happen at the same time. So any given year, odds are it's either going to be the commodity or it's going to be something company related. I can't think of a time I've seen both. So that's sort of, I find that to be intriguing and sort of navigating when you want exposure to one or the other of those variables is interesting. And that doesn't take the form for us of, say, entering a position outright, but we may trim or add, depending on, sort of whether, and you can sort of decompose the results and sort of look. And so decompose the results last year, say, for copper miners. And we have some copper miners that we like for fundamental reasons associated with management, associated with the assets they own. But the returns were just driven straight by copper price last year. I added no value or insight into the returns that those positions generated via my research. It was just the copper price. And I didn't add to those positions at that time because I just wasn't adding any value, and I have no way of knowing what copper prices are going to do or the sentiment around the copper price. And so I wasn't going to add to them. This year, I have some copper miners who have a lot of catalysts, a lot of things that the companies are doing, and I have an expectation that those companies will move this year because of those things. And so I'll add to them a little bit when I can.
Yeah, so perhaps that's where the misconception comes from, is that at any given time it's one of those two things.
Yeah, I mean, I think most people tend to just assume it's the commodity price, but it's really not. Another one that I think is interesting, and I see this one all the time. People are like, well, I don't want to invest in, say, oil and natural gas companies, but I'll invest in the service providers. Yeah. I'll invest in the shovels, but I won't invest in the producer. As if the shovels are somehow safer. That's the common perception. And it's a common perception in part because back when mining was first started in the United States and people would go west, yes, it very much was safer to sell a shovel to someone in any whatever little Arizona town that had a silver mine than it was to actually be in the silver mine trying to shovel dirt. But these days, if you look at it, oil field service providers are just going to run with the oil price. And so then the question becomes, and to be perfectly frank, they actually correlate almost in many regards a little bit better at times, the service providers. So that idea, which is very common, is mostly nonsense. Buy a service provider if there's a service provider you like for fundamental reasons, not because you want to avoid a producer because you think they have more commodity price risk. The service provider doesn't have direct commodity price risk, admittedly, but they are just a derivative. And so in some regards, just like other derivatives, they tend to have a slightly more dramatic associated movement than sometimes the underlying. Not always, but quite frequently. So that idea that you can go picks and shovels instead of the producer and be safer is nonsense.
Appreciate that insight. So as we start to wrap up, I just have a few other questions I wanted to get your take on. So this is a question I like to ask a lot of fund managers, is sort of around the ideas of skin in the game and sort of what your personal capital needs are, et cetera. And it really kind of takes the form of a two-part question. A, sort of how important do you think it is to be heavily invested, at least proportionally, alongside your partners? And then B, is it a good thing or a bad thing for a fund manager to sort of require to depend on their success for their livelihood, or to have some other sort of means to meet their personal capital, if that makes sense?
I would insist upon the manager being pretty heavily involved, or heavily invested, excuse me. I myself have 75% of my net worth that is not my house. Houses change the math in weird ways. 75% of my liquid net worth is in the fund. Will it always be 75%? I got no idea. We'll have to see how things grow and whatnot. But I would insist upon it. You got to eat what you kill. And it very much aligns interests, obviously. In terms of having another source of capital or something to help support you, if it makes it easier to start, absolutely. But there comes a point where, and you can certainly raise sort of like, say, friends and family capital if you're, say, doing another job, but you're never going to get beyond that. In terms of ideas like sort of the Real Asset Handbook and monetizing that and our research subscriber list, that's very easy. It doesn't distract from the core business at all. And so if you have an opportunity like that, you should absolutely take it. That's just money that you're sort of leaving on the table. But it's an all-consuming job. So doing other things at the same time is pretty hard. Yeah. Especially, I've got all sorts of service providers now who take a lot of the work off my plate, but I still have marketing, I still have sales, I still have to sign off on all the tax documents, I still have to ensure that all the regulatory stuff is, in the end, the buck stops with me. I'm responsible. So I still have to make sure all the regulatory stuff is squared away. So I'm running the business and operating the portfolio, if you will. There's a lot of work to be done. So it'd be a tough job to do with other responsibilities.
Do you have habits or routines that you think have contributed to your success that you think others could implement?
Nothing that everyone hasn't heard before. Well, maybe not. I think that continuously trying to refine your process after the valuation and for the valuation of a company or an idea. Those are two areas where we once again come back to that idea that, if you pick up an investing book, what's it about? It's about valuation, right? It's about how you value a company. But these other two sides of the equation, continuing to refine that process, I'm not sure, I don't know, I have no idea, to be perfectly frank. I'm not sure everyone spends as much time on that as I do. I spend a lot of time thinking about refining those sort of the idea sourcing part, and then once it's deployed, managing the position and things like that. That's what all that sort of discussion of AI at the beginning is of this conversation. That is all refinement of this initial sort of idea generation process. It's how do I collect information, synthesize the information to come up with actionable ideas as efficiently as possible. It doesn't necessarily need to be quick, but it needs to be efficient. And so I think spending a lot of time on process is low-hanging fruit that I'm not sure everyone spends as much time on as I do. But the other stuff is all stuff people have heard. Read continuously. Get up early and work out, and make sure that everything else in your work hard to make sure everything else in your life is squared away, so that when you get to the office you can focus. So I don't think there's anything particularly unique there.
Books or resources you've most often recommended?
Books or resources I've most often recommended. John's book is very good. The Manual of Ideas. There's a book called The Art of Execution, which I think has probably been brought up or mentioned by other MOI subscribers before. I think that's a really good book. It's one of the few books discussing, again, that post-investment period, how you manage the position over its life, that I think is very good. That's the only one that comes to mind right now for some reason. But I think, reading history is quite helpful. I've been flabbergasted by the number of Substacks that I read at this point, given that it was, zero, 2 years ago or something. So that's quite interesting. I think there's a tendency. So look, my portfolio's got maximum 16 positions on the long side. Okay, so it's relatively concentrated. It's not as concentrated as some, but it's vastly more concentrated than most people, and 50 to 60% of the portfolios in our top 5 positions. So in that regards, it's pretty concentrated. But for stock pickers, I'm not sure we spend enough time exploring and understanding what other types of investors do. And I find, I can't think of an example, but I find something quite useful and helpful about, what does a CTA do, for example, and how do they trade, and how are they thinking about markets? I think it adds color to the way I look at markets. Or say someone like Stanley Druckenmiller, who, I don't think he does anything that a value investor would per se sort of recognize as investing. But he's been extremely successful and, for example, says, well, I always start with a chart, right? And he has some technical indicators that he looks at. That's probably borderline heretical for some value investors. But if it's good enough for Stanley Druckenmiller, then it's definitely good enough for me. And so learning some of those other, skills, investing, can be quite siloed, and it can be quite isolated, right? Like, I sit in my office all day, and I don't think next week I have a single call scheduled. I just have research time. I'll probably talk with some people, but I got a lot of annual reports and stuff like that I want to read. So I may go the entire week without talking with anyone. There's a lot to be learned out there. And to allow yourself to fall into that silo every once in a while is fine. It's very productive. But you should really make an effort to try and learn from other people. And I've found learning a lot more about volatility and volatility traders and what they do to be quite helpful in sort of looking at the market on a day-to-day basis and saying to myself, well, I don't really need to worry about this craziness that's going on. Now, we all know that as long-term investors, but helping yourself get to that point behaviorally so that you can do it very comfortably is of great value. And talking with volatility traders has helped me do that. So I think not being too siloed in your approach and being open to letting other things come in is quite helpful.
Well, thank you very much, Will. I'd love for you to have the last word if there's anything that you sort of would summarize in terms of advice, or any ask of our audience, or anything coming out of Massif or the Real Asset Handbook that you want to plug out there as we wrap up.
Yeah, look, I'm always available to anyone in the MOI community. Always happy to talk ideas. Love every once in a while someone calls me up with something that is not real asset related, and says, "What do you think about this?" I always take have a great deal of fun with that, just because it's something completely new for me, and someone is just like that siloed sort of thing. Someone is saying, let's step outside the silo and see what someone who doesn't do this or doesn't focus on healthcare thinks about this. So I love looking at new ideas. So always happy to look at new ideas from the MOI community, and would self-interestedly encourage everyone to go to the Massive Capital website and sign up for the Real Asset Handbook, and read some of our back stuff. And if you think it's worth paying for, go for it. So that's probably about it.
Well, thank you very much. Appreciate you joining us. Thanks.
Well, thank you.